Rohr here with a Global View Trend View video early on Friday, June 13th, 2014. And it's currently approximately 6:45 a.m. Central Time. And this will be a global view getting back to some real movement in parts of the foreign exchange market again, even though others remain somewhat quiet. And we can only say that there's quite a bit of shift in the overall market psychology on the macro view. And we're coming in from the idea that maybe instead of central bank accommodation that makes bad news good news for equities, maybe for various reasons we're back to bad news is bad news. But first let's consider that coming in out of the data yesterday that was kind of mixed overseas, we saw weak U.S. retail sales. And later on yesterday, in the evening UK time, Bank of England Governor Carney gave the annual Mansion House speech that countered the recent ECB accommodation with some pretty hawkish comments on the rate hike that has been pending for a while in the UK might come sooner than expected. That's added to talk by certain Fed governors that the Fed might be getting a little behind the curve in its complacency on rates remaining low. Now, that was a major influence into some of the markets today, and we'll see what it did to the FTSE, to the short sterling. And we also note, though, that the Bank of Japan then, early today, gave a policy statement that was rather dovish still, and that's not surprising given their situation. So it's all about country influences now, which can be very different country to country, but it's no longer an across-the-board weak economic news is considered to provide central bank accommodation. No longer bad news is necessarily good news. Japanese industrial production, Chinese retail sales both strong. Interestingly, UK construction output was also strong. The only weak sister was the Eurozone trade balance. And we move into only the U.S. PPI and preliminary Michigan sentiment, and we'll see if bad news can be bad news. Certainly, a lot of the equity bulls might have felt like yesterday was Friday the 13th because it looked like they ran into some bad luck. And we can see that in the activity of the equities, and a lot of the technical discussion is going to be quite a bit briefer today because once markets move, we can focus on the actual enforceable levels that we've seen. And as we noted on the short-term charts of the S&P previous, and this is the hourly on the left, 30-minute on the right with indicators below, we saw where the old upside objective, and this is off of the daily and weekly charts as well, up at 1938, had been hit last Thursday on ECB accommodation, exceeded on the positive U.S. employment report Friday, but after a further high on Monday, the market started to stall and formed a micro head and shoulders top, gapped down onto a breakout Tuesday that didn't seem to be getting much traction until you gapped lower on Wednesday. And the importance of all this is that this down break was right around this week's oscillator level at 1945. And therefore, the market had tried to overrun oscillator resistance for this week, even out of the end of last week and early this week, and overrunning the objective at 1938, and subsequent, the downside objective of this top was right around 1937. So it's kind of like getting below 37 yesterday was a failure on multiple levels, capitulating back below the old 38 upside objective while it was outperforming the downside objective, failing on a downward acceleration out of its downward channel. Again, short-term trend, but there was a downward channel since the high. It was downward acceleration. And closing off the gap higher out of last Thursday's 1938.50, and most importantly, without much below it because of the way it ran up to a new all-time high Thursday, not much below it till back in the 1925 level, and look at how the market bounced from 1925 later in the day. However, presently, it's off around 3 on the day, back around 1927, and you'll note that the heftier congestion support down in here is in the 1923 to 1917-18 sort of area. And also note that the runaway band to the downside was violated on the hourly MACD without some improvement, probably breaking up back above this aggressive downward channel on the 30-minute chart, which it's not going to do early up at 1933, but maybe after lunch today, if the market can get back above 1930, get back to higher on the day, it would diffuse the downside momentum. Otherwise, we expect those lower supports, maybe even in that 1918 level, to be seen today. And on the short-term view, that pretty much does it. On the intermediate-term view, what we have is a market that, again, overran oscillator resistance. It was up beyond 130 to 135 over, but at present is back down to 119 over. This feels like a little bit of exhaustion, but it's important to note that there is further support back around the original runaway gap from 2 weeks ago in the 1900 area, with heftier congestion into the upper 1800s, and that also correlates to the Fibonacci supports you saw on the short-term charts. And the other key right now that means the market might be going into a bit of a more distended reaction is the fact that we could have a downturn in the daily MACD after the dramatic upturn on the push up above 1900 going back a couple of weeks ago. And that pretty much does it for the intermediate term picture of the S&P.